The committee will come to order, and without objection, the chair is authorized to declare a recess of the committee at any time without objection. Members of the full committee not on this subcommittee are authorized to participate in today's hearing. The hearing is entitled Promoting Economic Growth, a review of proposals to strengthen the rights and protections of workers. I now recognize myself for 3 minutes to give an opening statement. We spend a lot of time in the subcommittee talking about the relationship between companies and their investors. But the relationship between companies and their employees is just as important to the economy. Public companies have hundreds of thousands of employees, and almost all of the largest companies in the country are public companies. So the policies they have for employees and the wages they pay set the tone for the rest of the economy. This hearing will examine 4 bills on public company workers. 2 of the bills we'll be discussing today come from Ms. Cindy Axne. First is the Outsourcing Accountability Act, which would require companies to disclose in their annual report the total number of employees they employ in each state and each foreign country. The bill also requires companies to disclose how those numbers have changed from the previous year, which is critically important because it will allow investors and the public to monitor which companies are sending U.S. jobs overseas, and also to see which companies are bringing jobs back to the United States. The second bill from Ms. Axne would require companies to disclose much more information to investors about their human capital management policies. Companies often say that their employees are their most valuable asset. And if that's true, then information about the makeup of the company's workforce is of paramount importance to investors. For example, investors need information about overall workforce skills and capabilities in order to know whether the company has the capacity to take on projects that require a very specialized skill set. Ms. Axne's bill would require companies to disclose this kind of information, which is critically important in today's modern economy. Next, we have a bill that would require the SEC to conduct a study on stock buybacks. I think this is an incredibly important issue, and I certainly hope that this isn't the last bill we take up on stock buybacks. U.S. companies spend up to 60% of the tax cuts they received in the Republican tax bill on stock buybacks. They could have used that money to raise their workers' wages, or to invest in new equipment, or in research and development. But instead, they used buying back their own stock and enriching their own executives. The bill we're examining today would require the SEC to study how buybacks can be misused to benefit executives and the impact that buybacks have on employee wages. Finally, we have a bill from Mr. Phillips, which would require companies to disclose how much of a pay raise it's giving to executives every year and compare it with the pay raise it gave to its median employee. I look forward to hearing from all of our witnesses on these important bills. And with that, the chair recognizes Mr. Hollingsworth for 4 minutes for an opening statement.
Well, I am going to read Mr. Huizenga, who's out ill, opening remarks for this subcommittee hearing. America's robust capital markets are key to our long-term economic growth. Businesses of all sizes depend on our capital markets to access financing, to get off the ground initially, sustain operations, manage cash, make payroll, and even create more jobs. Although our capital formation framework is better than it was a decade ago, it is troubling that many of today's rules and regulations have discouraged companies from going public. Unfortunately, the U.S. continues to witness a downward spiral in the number of new businesses being created, which in 2016 hit a 40-year low. The U.S. has only seen half the number of domestic IPOs that it did 20 years ago, while the U.S. has doubled the regulatory compliance cost a business must undertake. With more companies opting for private fundraising rather than the public market, the number of public companies has decreased to levels not seen since the 80s. In fact, 20 years ago, American investors could pick from over 7,000 listed stocks. Today, that number stands at merely 3,500. This means that everyday investors on Main Street, such as John and Jane 401k, are missing out on valuable opportunities to invest in the next Microsoft, the next Amazon, or the next Google. IPOs have historically been one of the most meaningful steps in the life cycle of a company. Going public, as it is termed, was the ultimate goal for entrepreneurs. You start a business from scratch, you build it into a successful enterprise, and then open up the opportunity for the public to share in your success. Going public not only affords companies many benefits, including access to the public markets, but IPOs are an important part of the investing public. By completing an IPO, a company is able to raise much-needed capital for job creation and expansion opportunities while allowing Main Street investors the opportunity to have an economic piece of the action and the ability to participate in the growth phase of a company. For myriad reasons, the public model is no longer viewed as an attractive means of raising capital. Companies are drowning in a sea of regulatory red tape and increasing compliance costs created by Washington bureaucrats. This is truly troubling. Instead of constructing arbitrary walls that cut off access to our capital markets, Congress should be working to create an atmosphere that helps promote more capital formation, to allow the free flow of capital, strengthen job creation, and increase economic growth. However, the 4 draft legislative proposals that we are examining today do very little to promote economic growth. Instead, these bills will do nothing but impede economic growth. By mandating the additional disclosure requirements, it will only increase compliance costs for companies, take away precious resources that could have been used to hire more workers, increase wages, and grow these companies. Instead of working to protect investors and helping to facilitate capital formation, these proposals will be more focused on exerting societal pressure on public companies by demanding meaningless information that are not material to investors making investment decisions. The increased cost for complying with these hollow disclosures will only stifle growth and discourage more companies from going public, ultimately hurting American workers and Main Street investors. And with that, I'll yield back.
Thank you. The chair now recognizes the gentlelady from Iowa, Ms. Axney, for 1 minute.
Thank you, Chairwoman Maloney, and I also want to thank all the witnesses for being here. I'm so happy that we're having this hearing today to promote long-term economic growth, and the 2 bills I'm sponsoring will help with that. The first is the Outsourcing Accountability Act that requires that public companies disclose in their annual report the number of employees they have in each state or country. I was personally surprised when my staff told me that companies don't report this data, and having this information would help consumers and investors make decisions to support companies that help build American jobs. Secondly, my other bill discussing today would increase disclosure about human capital management practices at companies, including workforce safety, compensation, and skills training programs. This subject's very important to me since I was hired by Chicago Tribune now almost 20 years ago as a human capital manager. So I know companies have been working on this in a long time and have invested in human capital management. And better disclosure of these practices will help us focus on long-term growth of companies and the American economy. Thank you, and I yield back.
The chair now recognizes the ranking member of the full committee, Mr. McHenry, for 1 minute.
Well, thank you, and I appreciate you, the chair yielding. The American economy is strong. We had an unexpectedly high economic growth rate for the first quarter with 3.2%. Job creation was 263,000 new jobs created last month. Unemployment was at its lowest level in more than 50 years, and wage growth has increased to over 3% year over year. This is a significant thing. In short, the American economy is strong, and yet we know not everything's perfect. We know that there are fewer stock listings for average everyday investors to be able to participate in. That is a problem. It's halved over the last 20 years. That's significant. And what we should be talking about as a committee is how we encourage more public offerings so that average everyday investors and pensioners can hold those assets and benefit from a rising economy. How can we link that greater economic growth to individual gains in our society? That should be our conversation rather than the social engineering and government mandates that we're currently discussing in this hearing. And I fear that by imposing these mandates, we'll actually have fewer public offerings and fewer encouragement to participate in the public markets. And so I think we can work together to achieve some bipartisan results, but we need to focus on what is really important, not social experimentation.
Thank you. I now recognize the gentleman from California, Mr. Sherman, for 1 minute.
The Republicans have pointed out that sometimes we load up burdens on publicly traded companies, and maybe that discourages companies from going public. And I'll agree. That's why all the requirements we're talking about now should apply to public companies and private companies, and any company that has expenses or revenues of over $100 million in the United States. Because these companies play an important role on our economy. And if you're a median worker not being paid enough, that shouldn't matter to you whether your company is held by private equity or whether it's publicly traded. So we need information for our society from all of the major companies, and I look forward to realizing we're not the SEC where our powers might be limited to publicly traded companies. We are the United States Congress, and we ought to have legislation that applies to all major companies, no matter how they're owned. I yield back.
Today, we welcome the testimony of a very, very distinguished panel of witnesses. First, we have Stephen Clifford, who is the author of The CEO Pay Machine and served as the CEO of King Broadcasting Company from 1987 to 92, and as CEO of National Mobile Television from 92 to 2000. Second, we have Heather Slavkin-Corso, who is the Director of Capital Markets for the AFL-CIO and is a Senior Fellow at Americans for Financial Reform. Next, we have Dr. Abigail Disney, who is the President of Fork Films and is the Chairperson and co-founder of Level Forward, which is located in the district I'm privileged to represent. We also have Neely Gilbert, who is the co-founder and portfolio manager at Materin Capital Management, which is also located in the district I'm privileged to represent. But last but not least, we have James Copeland, who is a senior fellow at the Manhattan Institute, where he serves as the Director of Legal Policy. Witnesses are reminded that your oral testimony will be limited to 5 minutes. Without objection, your written statement will be part of the record. Mr. Clifford, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you. I served on over a dozen corporate boards and chaired the Compensation Committee for both public and private companies. In that role, I got to see how CEOs are actually paid. I got to look at the pay system that's used in all large companies today for CEOs. As I saw it at work, I said, this is crazy. It overpays the CEO. That's a small problem. Much bigger problem was its impact on morale, and the worst problem was it created perverse incentives and pushed everybody towards short-term metrics. So to convince my fellow board members to fire our very expensive consultants, I began to do some research, and I concluded that it does hurt the companies that use it. It also impedes economic growth, and it's a principal driver of the rising income inequality. Now, let me state that I believe in free market capitalism. I think with a light regulatory touch, this is the best economic system known to man. I criticize CEO pay because it has nothing to do with free markets. And it hinders a robust capital economy. I mean, first of all, it has nothing to do with supply and demand. Now, a market sets the rate for supply and demand sets the rate for athletes and movie stars. Teams and studios bid for their services because their services are portable. LeBron James is going to improve any basketball team he joins. Meryl Streep's going to improve any movie she's in. Most CEOs would not improve another company because their competence rests largely on the knowledge of a single company. Its finances, products, personnel, culture, et cetera, et cetera. This is very necessary to run that company, but it's not worth much outside that company. That's why 3/4 of all new CEOs, and I'm talking about S&P 500 CEOs, are internal promotions. Companies rarely bid for an outside CEO. Less than 2% of all these CEOs were previously the CEO of another public company. CEO jumps between these companies happen less than once a year, and when they jump, they usually fail and are twice as likely to be fired than internal promotions. So with no auction market to guide them, These firms and consultants have put together a rigged, corrupted system, it's a totally administered system, of how to calculate CEO pay. It's a very complicated system. I'll explain it later if you want. But basically what they did was they started a game of CEO leapfrog. And CEOs just keep leaping over each other every year in pay. That has increased CEO pay by 1,000% since 1980. At the same time, the average working man's got virtually nothing. Now, the system doesn't pay for performance. Studies have consistently shown that CEO pay and CEO performance are uncorrelated or even negatively correlated. It doesn't align them with shareholders, and it's not needed to motivate CEOs. CEOs are the most motivated people you've ever met to start with. Perversely, this system channels that motivation, not towards long-term growth, but towards short-term financial metrics that will earn a bonus. For example, the average CEO serves only 4.7 years, gets 85% of his compensation in equity, and that gives him a compelling reason to have a high stock price. There are two ways of getting this. One is to actually beat the competition with better products at lower prices. The easier way is to buy your own stock. As you mentioned, the S&P 500 spent $800 billion last year buying back stock. Since 2016, those companies have not reinvested a penny. It's all gone for buybacks and dividends. The greatest damage falls not on those companies, but on the company itself. As I said, it's one of the principal drivers of the increase in income inequality. So here you have a system that enriches only the insiders who manage it, the consultants, the board, and the top executives. They're not going to change it. Shareholders pay on pay votes. Have ignored that you have a structural problem here, that the system used to pay them is rigged. And they vote only against the 1% of the most outrageous packages. So when self-serving CEOs and corporate directors neglect their fiduciary duty to the detriment of almost everybody else, I think it's time for government to exercise regulatory oversight, and so I support the legislation we're considering today.
Ms. Slavkin-Corzo, you are now recognized for 5 minutes.
Thank you. Chairman Maloney, Mr. Hollingsworth, and members of the subcommittee, thank you for inviting me to testify. The AFL-CIO and AFR work on behalf of millions of people to promote policies that create a safe, sound, and stable economy that helps all Americans achieve economic security. My work, to a large extent, focuses on policies to protect and grow the $7 trillion invested in collectively bargained retirement plans. Today, the subcommittee will consider a number of proposals aimed at promoting economic growth by strengthening workers' rights and protections in the capital markets. I commend the subcommittee for taking up these critical issues. Investors increasingly acknowledge that human capital management is a material financial factor that responsible investors must incorporate into investment decisions. HCM refers to a set of practices and strategies for how a company recruits, manages, and develops its workforce. Executives always say that their workforce is their greatest asset, yet rarely offer information on how that asset is maintained, cultivated, or grown, or what labor costs are comprised of, or how they are managed. Policy changes are needed to update disclosure requirements to require robust human capital management disclosures. Legislation being considered today would go a long way toward addressing the current lack of information available to investors. Buybacks. In recent decades, companies have spent exorbitant sums of money buying back their own stock. The 2017 Tax Cuts and Jobs Act hypercharged this practice. In 2018, companies spent more than $1 trillion buying back their own stock and are on pace to surpass that level in 2019. At the same time, the portion of corporate earnings used to pay workers is near all-time lows for the modern era. Excessive spending on buybacks has prompted concerns that companies are prioritizing short-term stock price jumps over long-term investments. Executives whose compensation is primarily comprised of stock-based awards gain the most from short-term maneuvers to boost stock prices. workers, and long-term investment in business improvements suffer. Congress must pass legislation to rein in stock buybacks. I'd also like to address two topics not on the agenda for today's hearing where policies from this subcommittee could substantially improve economic security for American workers. First is worker representation on boards. The single most effective way to improve workers' rights and address income inequality is to empower workers to command better wages, benefits, and working conditions. In the corporate governance context, this means ensuring worker representation on corporate boards. In many advanced economies with highly competitive private sectors, worker representation on boards has been the norm for decades. This must be part of a broader conversation about how we incorporate stakeholder interests into corporate decisions. And finally, private equity. Working people are exposed to private equity as employees, investors, and participants in the American economy. PE-owned companies employ 11.3 million American workers. When the companies fail, these workers often lose their jobs, benefits, and retirement plans. Toys R Us, Topps, Hagen, and Caesars are examples that left tens of thousands of workers unemployed. Sears, owned by a hedge fund that used private equity-style strategies, is yet another example. At the same time, U.S. pension funds collectively have more than $800 billion invested in private equity. Unfortunately, the exorbitant fees that go along with this investment do more to enrich the already extremely wealthy general partners than they do to provide for the retirement security of pensioners. Finally, regulators in the U.S. and around the world have begun raising alarms that the outstanding risky loans used to finance LBOs could create systemic risks. The private equity model exists and is remarkably profitable due to a series of loopholes and carve-outs in securities, bankruptcy, and tax law. There is no public interest reason to provide these. In fact, I would argue that the public interest demands that policymakers eliminate legal and regulatory privileges that feed abusive LBOs. I encourage the committee to consider these issues. In conclusion, the best way for investors to do well is to invest in a stable, sustainable, and growing economy. Sound economic growth requires employers to invest in workers and workforce development, to provide family-sustaining compensation packages so that our consumer-driven economy can thrive, and to devote resources to strategies that give their enterprises the chance to prosper in the future. Thank you, and I look forward to your questions.
Dr. Disney, you are now recognized for 5 minutes.
Thank you. Thank you, Chairwoman Maloney, Ranking Member McHenry or Hollingsworth, I got confused there, and members of the subcommittee. I'm a filmmaker, an activist, and granddaughter of Roy O. Disney, who co-founded the Walt Disney Company with his brother. I have no role at the company, nor do I want one, and I hold no personal animus to anyone there. And I do not speak for my family, but for myself. But today I hope to raise some simple questions about CEO compensation. Does a CEO's pay have any relationship to what his hotel maids and janitors get? Do the people who spend a lifetime at the lowest end of the wage spectrum deserve what they get? Or does any full-time worker deserve the dignity of a living wage? Disney is not just any company. It is not U.S. Steel or Procter & Gamble or any other iconic American brand. The Disney brand is an emotional one, a moral one. I would even say it is a brand that suggests love. I have spoken up as a Disney about Disney because I'm uniquely placed to do so, and because Disney is uniquely placed in American life. Those moral undertones and all that love need to be put to constructive use because this is a moral issue. Bob Iger is a nice man, a brilliant manager, and so are most CEOs. But corporate excess has become so normalized that they and their peers can't really see the problem anymore. It's hard to worry about a problem that builds slowly, but the corporate emperor is wearing no clothes. In fact, he's been doing a long, slow striptease since the 1980s. There is nothing inherently wrong with a $65 million payday as long as your own employees, people my parents and grandparents taught me to love and revere, are not so strapped for money that they have to ration their insulin. Offering education is nice, but what they might earn someday in the future has nothing to do with what they earned working all day today. These are not the values my family taught me. This company could lead if it so chose. Disney led when it offered benefits to same-sex partners. It led when it prioritized the environment. Disney could lead once more. All it lacks, ironically enough, is the imagination to do so. The burden is not just on Disney, and Disney is a long way from being the worst offender. But for the time being, let's just focus on what Disney could do. Disney could tomorrow raise the salaries of all of its workers to a living wage, and nothing about doing so would constrain any capital market anywhere. Disney could take half of this year's enormous bonuses and put them into a dedicated trust fund that would help with employees' emergencies. It could offer stock options to all employees and not just to people at the top. It could hold 2 or 3 seats on the board for employee representatives. After all, when your board is filled with people who are or want to be CEOs, you're unlikely to get a lot of pushback about your bonus. I sincerely hope you'll pass the Human Capital Disclosure Bill, but I humbly want to suggest one change to it. Many people focus on Robert Iger's 1,432 times pay ratio, which is outrageous indeed, but this is a wildly imperfect measure. That ratio doesn't reflect the fact that in some sectors, median workers' pay is higher than in others. That means that a banker is not getting called on the carpet for his compensation, even though he is just as guilty of driving his own workers' wages down while walking away year after year with millions. We need to measure the CEO's ratio to the salary of his lowest full-time worker. Why on earth do we currently behave as though one's fate has nothing to do with the other's? Low-wage workers' lives are rendered invisible by the current measure, and that has made it too easy to assume that their lives have nothing to do with management's. We have chased vast swaths of Americans into a box canyon and then blamed them for being trapped. Philanthropy is often offered as an answer to the problem, but this is not a question of individual decisions. We are talking about the consequences of structures that create and enforce deeply unfair and inequitable social structures. We need to change the way we understand and practice capitalism. Yes, managers have a fiduciary obligation to their shareholders, but they also have a legal and moral responsibility to deliver returns to shareholders without trampling on the dignity and rights of employees and other stakeholders. It was possible to do this when my great-uncle and grandfather built the company. It's possible now. People made this problem, and by people, it can be fixed. Thank you.
Ms. Gilbert, you are now recognized for 5 minutes.
Good morning, and thank you, Chairwoman Maloney, Ranking Member Huizenga, Mr. Hollingsworth, and members of the subcommittee for inviting me to testify. My name is Neely Gilbert, and I'm co-founder and portfolio manager of Matarin Capital, which is an institutional asset management firm based in New York City. I also speak with you today as the chairwoman of the investment committees of both the David Rockefeller Fund and the Synergos Institute, and as a young global leader of the World Economic Forum. I am testifying today not for Matarin Capital, but only for myself, and my remarks constitute neither recommendations nor solicitation for any investment. I'm testifying in support of the bill to amend the Securities Exchange Act of 1934 to require issuers to disclose information about human capital management in annual reports. Asset owners from Wall Street to Main Street, and many asset managers like me, are increasingly seeking better understanding of certain material non-financial information about the companies of which we, as shareholders, are owners. This call would require issuers to disclose data about human capital and is rising because better insight into this field would help us to better understand the broad macroeconomic environment in which we are all operating, and also because we know that better data about individual companies can help us to generate better investment results. This data that's been requested in this bill have been culled from the Embankment Project for Inclusive Capitalism, a multi-stakeholder initiative in which 32 companies representing $30 trillion in assets came together to identify human capital management practices that were found to be value-creating. The specific items put forward in this bill should not be too onerous for companies to collect and will be broadly relevant across a wide group of companies and are supported by studies which have shown this data to be material. As a traditional, quantitatively driven investor, I can give you a sense of how lack of data availability is playing out on the ground. Our clients are increasingly interested in identifying non-financial risks and opportunities in their portfolios, and although we're actively seeking ways to respond to their requests, we're often running into limitations when it comes to finding the data that we need. Since companies are not making standardized disclosures on human capital, many investors are forced to use data prepared by third-party vendors, which is subjective, less standardized, and may even contain errors. Third-party data is also very expensive, which means that the average individual investors may be at a disadvantage when it comes to their own investments. Regulatory standards have proven effective in the past in offering frameworks that investors can rely on for receiving sound financial data that we can trust, and the same could be true in this case. Standardizing disclosures could also help American companies by lowering their reporting burden over time. Currently, there are over 150 different rating systems of non-financial data, which are trying to fill in the gap that has been left by a generally accepted standard. Corporate leaders have begun expressing fatigue from having to complete so many reports that are all requesting disparate kinds of data. Standardization in the future could help to mitigate this. Additionally, intangible value is becoming an ever more important part of our economy. Traditional financial data helps us to be informed about companies' physical, tangible assets, but over the course of the past several decades, a significant portion of American companies' assets have become intangible. For example, talent and the patents that it generates. With that being said, we're also living in a moment in history in which the role of labor in the production process is in flux. With the rise of robotics and artificial intelligence, there's an open question about how and to what extent companies will use human workers going forward. By gathering clearer data today about issues such as worker skill gaps and training, workforce stability and turnover, and workforce productivity trends, we would have the information required to prepare for those changes of tomorrow. I know that within these walls there have been many debates about how American institutions should behave, but I and other market participants like me are seeking information when it comes to disclosure. I believe that the markets have the potential to reflect the emerging realities of the present and the future, but as the old adage goes, we manage what we measure. Please give us the tools that will be required to measure even more of what matters for generating successful investment returns and creating an economy that will support a bright future for the American people. Thank you.
Mr. Copeland, you are now recognized for 5 minutes for your testimony.
Thank you, Subcommittee Chairwoman Maloney, Chairwoman Waters, Representative Hollingsworth, members of the committee. I appreciate the opportunity to testify. My name is James R. Copeland. I'm a senior fellow with and director of legal policy for the Manhattan Institute for Policy Research. And the proposed legislation under consideration by the subcommittee today significantly intersects with my areas of research. I believe that each of the draft bills is seriously misguided. Each is likely to retard, not promote economic growth. And I strongly urge the committee not to take up these ill-considered pieces of legislation. Let's turn first to the 3 disclosure bills. The statutory text that the federal securities laws expressly call on the SEC to look at material facts to be disclosed to investors, as Ms. Gilbert was suggesting. In his opinion for the Supreme Court in 1976, TSC Industries v. Northway, Justice Thurgood Marshall explained that some information is of such dubious significance that insistence on its disclosure may accomplish more harm than good. Unfortunately, in recent years, the SEC has been prodded by this body to require just the sorts of disclosures that worried Justice Marshall, as I discuss in my written testimony. The 3 disclosure bills before the committee follow that trend. The pay raise bill is basically a warmed-over version of the pay ratio disclosures currently required under Dodd-Frank Section 953B. That has been aptly characterized as a disclosure as soundbite rule, likely to prompt media stories, but very unlikely to be useful to a profit-maximizing investor. There's generally little reason to expect the ratio of CEO pay and median worker pay to be constant or meaningful. Last night, the NBA held its draft lottery. Mr. Clifford's wrong. It's not the market that sets LeBron James' salary. It's the collective bargaining agreement with the NBA. And there's no reason to expect NBA salaries under the maximum contracts to have any relationship to the average wages of concession workers. Ditto when comparing the compensation of headliner Hollywood actors and actresses against that of film crews. It's not Bob Iger, talked about by Dr. Disney, who's the highest paid employee at Disney this year. It's Robert Downey Jr., who just got $75 million for the new Avengers movie. The right comparison group for chief executives is not the median company worker, but a host of competing candidates for senior executive services, including not only other businesses, but other employers that might employ top business talent, such as private equity firms, such as investment banks, management consultancies, and of course, entrepreneurial ventures. The rise in executive pay over recent decades is real, but it has been driven by stock investors, chiefly institutional investors, that have sought to align managers' incentives with those of shareholders through a variety of equity compensation vehicles. The strategy has paid off. Over the last 3 decades, the broader stock market has grown tenfold. The committee has before it 2 other additional disclosure bills. Each fits into that pay ratio disclosure as soundbite paradigm. The outsourcing bill would require companies whose stock trades on public exchanges to publish lists of workers by country, which would doubtless generate confusion. Companies using wholly owned subsidiaries would appear to have more foreign presence than those contracting with foreign firms. The so-called Human Capital Management Bill would require the SEC to implement a host of detailed disclosures around workforce composition and management, including diversity data and goals. But there's little reason to believe that such disclosures are material to the profit-maximizing investor in general. Indeed, over the last decade, shareholders have routinely considered and rejected shareholder proposals suggesting the publication of such data. Let's turn to the share buyback bill. It addresses a phantom problem with a counterproductive solution. The return of capital to shareholders, more than 70% of which are institutional investors that reallocate capital, is the most efficient way to shift societal resources to their highest value use. Consider that 5 of the 6 largest companies in the world today are American companies, and they simply did not exist 50 years ago. 3 of them did not exist 25 years ago. Any laws or rules that would limit shareholder corporations from returning capital to investors, instead favoring retained earnings, is simply foolhardy. Of course, companies can pay out capital through corporate dividends, but there are sound economic reasons why a company's board of directors, acting as fiduciaries, would prefer share repurchases in many cases to common dividends, as I outline in my written testimony. There's simply no reason to saddle the SEC with a new study, a new rulemaking proposal, as suggested in this bill. In conclusion, I believe that each of the draft bills is seriously misguided and likely to impede, not promote, economic growth. I encourage members of the committee to ask questions, which I will endeavor to answer to the best of my ability. Thank you.
Thank you. I'd first like to question Dr. Disney, but first comment on her very excellent article that was recently in the Washington Post on compassionate capitalism, entitled, "It's Time to Call Out Disney and Anyone Else Rich Off Their Workers' Backs." I ask unanimous consent to place it in the record. So, okay, thank you. So Dr. Disney, you spoke really very passionately and I'd say persuasively about the need to rein in executive compensation, and you obviously know a great deal about it and know a lot of highly paid executives. So let me ask you a simple question. In your opinion, do most executives respond to policies that shame them for their extravagant pay packages that are just really outrageous when you see it, $79 billion versus $7.1 billion. They're paid 11 times as much in tax cuts as they're giving out to workers' bonuses and our wage hikes. Or are most of these executives absolutely immune to public shaming over their compensation packages?
I think the shame is probably not going to work very well unless the shame comes from inside. And that's why I think that much of the change has to be an ethos shift, a culture shift, because pundits, commentators, people who write in newspapers about business have all consumed and swallowed whole this idea that a company exists solely for its shareholders and solely to maximize profits. And that is simply not true. Companies have always had other stakeholders, and it's certainly companies have moral obligations to their employees. So that's why I argue that the median worker ratio is, in fact, not a helpful ratio, because it treats the lowest paid worker as though they're invisible or not even really employed at the same company that they're laboring every day to promote the well-being of. So I think that what needs to happen is to be, first of all, a shift in consciousness about what we're doing when we start a business. There are certain things that just aren't optional. If you can't afford to pay your workers a living wage, then you can't afford to hire your workers. And we need to stop and remember that certain things should be thought through at the beginning, at the top of the waterfall, when your revenues come in, and not at the bottom once everybody's taken their share, so that you can give the leftovers to your employees or whoever else is being treated poorly. As long as you have employees working full-time at your company that are sleeping in their cars, that are rationing their insulin, that are driving 3 hours each way to get to work, that are having their hours changed in a whimsical way that prevents them from being able to supplement their income with second and third jobs, as long as any of that is happening, and your CEO is walking away with $65 or maybe as much as $97 million in a year, this is just simply on its face morally wrong.
Thank you. Ms. Corozzo, I want to ask you about the company's human capital disclosure. Why are the current disclosures that companies make about their workforces inadequate, and what kind of disclosures do companies typically make?
Thank you. So right now, the basic information that investors get from companies is the number of people employed globally. It used to be that companies voluntarily would disclose the numbers in various jurisdictions, but that practice has declined in recent years. I think that it's probably due to the fact that, first, it's not mandatory to disclose where the workers are, and secondly, that as international firms have outsourced jobs, they recognize that that's a reputational risk and that it's something that they probably don't want to make public if they're going to have to answer for it. So right now, there's really minimal human capital disclosure that is made available to investors. It makes it really difficult for investors to analyze effectively how companies are managing what they say themselves is their most valuable asset. So there's a lot of additional information that would be extremely useful. There's a bill today that is about offshoring. That's clearly something that's very important for investors. Investments that are made in workforce development and education, money spent on wages and benefits, gender equality issues. There are a whole list of issues that would be really valuable for investors. There's really no single factor that can tell the whole picture, but as a whole, we know that investors are extremely interested in this.
Thank you, Ms. Gilbert. Would you like to comment on that? And as an investor, what kind of human capital disclosures do you think or do you find most important?
As an investor, when I think about human capital data, I'm using the information often to try to forecast a company's business or its stock price. And so sometimes when you learn about a company's business strategy and then you look at the numbers, you may find differences. And so we value having data as basic information to be able to evaluate whether what we hear about a company's strategy is really true. Currently, as Ms. Corzo says, we are using information about the number of employees, but we don't have good, clean information about how those employees are being compensated, treated, their benefits, and the other issues that Ms. Corzo describes.
My time has expired. The gentlewoman from Missouri, Ms. Wagner, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and I thank Congressman Hollingsworth for yielding. Mr. Copeland, I appreciate your testimony and being so specific on the ill-guided piece of legislation that have been brought forward today. There's been a decline in American IPOs over the last few decades and a growing trend of American companies opting for private capital as opposed to public markets. Should we find these trends concerning, and why?
I think we should. I actually testified here 13 years ago on this. I mean, the IPO thing is nothing new. It's a decades-long trend at this point. We actually probably are going to have, by dollar value, a good IPO year this year. But the number of publicly traded companies has fallen. Now, of course, the market capitalization has gone up. And so what does that tell us? It tells us that below a certain threshold, smaller companies are finding it disadvantageous to be a publicly traded company. And that's due to a host of regulations and other issues, some of which I point out in my written testimony.
I agree. And what impact do IPOs have on employment and job growth? And what does an uptick in U.S. IPOs mean for Main Street investors?
Well, there are two factors here, right? So one is IPOs give you a very liquid supply of capital, and it just doesn't make sense to starve new businesses of capital. That's what's going to generate jobs. But the second fact is the Main Street investor point is a very, very important one, because Main Street investors can invest in publicly traded stocks. They're going to have a harder time investing in private companies. And to the extent that our capital shifts more and more into private companies, we're going to look more like Italy, where you have rich families controlling businesses, and the average worker and the average worker's pension plan is going to be less invested in that. Now, some of this we work around because pension plans do invest in private equity funds and what have you. But really, you're going to have a disconnect and a two-tiered capital structure, which I think is unhealthy for our democracy.
You've already discussed how today's hearing and the bills put forward create additional requirements on American public companies, adding to their greatly adding to their regulatory compliance cost. None of the proposals discussed today would apply to private companies. So would these increased compliance costs for public companies deter private companies from going public?
Well, of course they would, and they already are. I mean, that's the point. We've just seen, until maybe this year, we've seen a real retreat in IPOs. We've seen consolidation. We've seen fewer publicly traded companies. And as someone who's invested in startup businesses, they don't want to go public. The last thing they want to do is go public because of all these requirements. Now, clearly, as Representative Sherman suggested, I mean, this body, Congress, has the constitutional power under current Supreme Court doctrine to start expanding its role into private businesses, but I think that'd be really misguided.
Mr. Copeland, in your testimony, you described stock buybacks as, quote, good for investors, and that they help to protect investors' interests, promote efficient capital markets, and facilitate capital formation. Can you explain why one-size-fits-all limitations on a company's ability to repurchase its stock or a complete ban on buybacks could result in the inefficient allocation of capital for a company and hurt the economy and wage growth in the long run?
Right. I mean, as I suggested in my oral testimony, I mean, we have a dramatic reshifting all the time of money from one value to another, and that's driven by these capital markets. So it shouldn't be surprising that there's a large number of share buybacks when their tax law changes. In fact, the tax law changes would prompt investors to want to reallocate capital based on that shift. And that's why we've got a market now that has companies like Facebook and Amazon and Google, which just didn't exist 25 years ago at all, valued so highly because we have these liquid markets. Now, if you just constrain it to corporate dividends, then you're constraining boards' ability to take advantage of their information if they think the stock is mispriced. But you're also creating necessary capital events if you actually pay out your earnings to shareholders, which means that an investment fund like Ms. Gilbert's buying and selling securities is going to be getting more taxable events. So you're not helping your investors out. You may be generating a little tax revenue, but you're not helping investors out by that.
And quickly, I may not have enough time, but how would executive pay ratio disclosure as proposed further solidify proxy advisory firms' influence over corporate governance matters for U.S. public companies, and what are the consequences of increased proxy advisory firm influence for public companies and their shareholders?
Well, proxy advisory firms are a big topic. I've written a lot about it.
Yes.
I've got some in my written testimony. I don't think it's going to affect how they behave because I don't think it's material. I don't think the pay ratio they're going to pay a lick of attention to.
I yield back. Thank you.
The gentlewoman's time expires. The chairwoman of the full committee, Mrs. Waters, is now recognized for 5 minutes.
Thank you very much, Ms. Maloney. This is a most important hearing, and as I came into this room, I heard some of the testimony, and I want to make a few comments before asking a question or two, and say to Dr. Disney, I am so proud of you and your courage. I am so proud that a woman who could enjoy all of the privilege that she would want to enjoy would have the passion and the commitment to go public and to come before this committee and tell the truth about what is happening at the family business. We don't have many people like that here in Washington, D.C. You are a prime example of what a real American citizen is. Thank you so very much for your courage.
The committee will come to order, and please respect the orders of the committee, which is no clapping, just focusing on the importance of the issues we're talking about. Thank you so much.
Thank you for reminding us, Ms. Maloney, but I love that clapping.
I did too.
Thank you. Just a couple of questions. Ms. Gilbert, I heard you when I first came in, and I was pleased to learn that you're co-founder of your firm and that you're working with CalPERS and maybe even CalSTRS. I was an assemblywoman at one time in the state of California and created the emerging funds for asset managers to break into the possibility of managing these firms in the state of California. Can you tell me, when you talk about this information that's so important to making good investment decisions, specifically, what are you talking about? Are you talking about knowing as much as you can possibly know about all of the employees? What kind of information? How does that really help you?
Thank you, Chairwoman, I'm familiar with the work that you did in the state of California. Without that work, Materin wouldn't exist today. Very grateful. There's something in investments called the fundamental law of active management, which says that the returns that you can generate in a portfolio are proportionate with the amount of information that you have about the securities that you may be potentially investing in. Of course, it's important that it be relevant material information. We've seen, and you'll note in the written testimonies, many academic studies that show that the material, that the data that's been requested in the bill on human capital management has been proven in academia to be material, but as investors, it's very important for us to take in clean data and evaluate it ourselves as we would apply it in the markets. I also would note that when we think about issues of human capital management today, that this has become a hugely important part of the American economy. When you look at our largest four sectors, it's technology, healthcare, financial services, and communications, all of which rely very heavily on talent and people to yield their success. Without having good, clean information about how that talent is being managed, we're simply not able to get a clear picture of what these key companies in our economy are truly doing.
So thank you very much. I appreciate that information. I think it was Ms. Carzo that talked about buybacks. And you know, we have gone through the President of the United States having initiated a tax reform bill, so-called reform, and where these companies told us and told the world that they were going to invest in their employees, that they were going to expand their inventory, on and on and on, and they were going to increase pay and bonuses, but they did not. Would you recommend that we go on record in terms of buybacks and that we use the power of this Congress to eliminate the ability to use funds that have been generated by tax reform from being used for buybacks?
Thank you. Yes, I think it's critically important that Congress take affirmative action to address the problem of abusive stock buybacks. As you mentioned, the Trump tax bill triggered $1 trillion in stock buybacks last year. That's $1 trillion that could have been invested in raising workers' wages, in developing research and new products, and in corporate growth. that would drive our economy into the next, several decades. So absolutely, I think this is a problem. I think that business today is eating the seed corn of the future, and we really need affirmative policies to stop the financial engineering and focus on what really matters in our economy.
Thank you so very much, and I'll yield back the balance of my time.
Thank you very much, Chair Lady. The gentleman from Indiana, Mr. Hollingsworth, is recognized for 5 minutes.
Well, Dr. Disney, I appreciate you being here, and like Chairwoman Waters said, I appreciate the verve and passion that you have for this issue. I wondered, I heard you several times say that the CEO of Disney makes too much money. I wondered if you might tell me how much money he should make.
Thank you for that question.
Great.
I wouldn't begin to tell you what the number is.
Okay,
that
great.
he
Tell
should
me
make, but let me-
reclaiming my time. You don't know what the number is. What should the pay ratio be between the median wage of Disney employees and the CEO of Disney?
Well, first of all, I believe that the ratio should be measured to the bottom.
I know, that's what you said. I'll ask you that question
If you
next.
take his salary
Yeah.
and assume he works a 60-hour week and never
it.
takes a vacation, he's being paid $21,000 an hour.
Got it.
So I would argue that that is, on its face, too much money for
What's the right
anyone.
number then?
It would be closer to $10,000 an hour. and
Is
maybe
$10,000
lower
the
than
right
that.
number for every CEO of a public company or just Disney?
Of course not. And as I said in my remarks, there's nothing inherently wrong with a $65 million payday as long as his employees are not going home and rationing insulin.
You also mentioned that you believe every employee should be paid a living wage. Will you tell me what that living wage is in San Francisco?
I would tell you that there are economists who could tell you what the living wage
What's
is
the
in
living-
different cities, depending
Reclaiming
on
my
the
time.
cost structures in those
What's
cities.
the living wage in Salem, Indiana?
I don't
what's
know,
the
but I
living
do
wage
know
in
in
Baylor?
Anaheim it's $24.
The point I'm trying to make is we are throwing around numbers here on appropriate CEO pay, what CEO pay should be, what living wage should be in X city, but there aren't any specifics on how we will do that, right? And what I continue to hear from you and others is, oh, we will just defer to a group of scientists who will endeavor to figure out what the appropriate CEO salary is, what the appropriate median wage is, what the appropriate living wage is in every single location for every single job, up and down the spectrum, sea to shining sea. That is, we have a definition of that. That is socialism.
Here we go.
We know what that is.
Okay,
and so,
so-
with respect, I've reclaimed my time. Mr. Copeland, I want to talk about the outsourcing bill that's been presented, right? One of the things and challenges associated with this particular bill is that it merely outlines the number of employees located in the U.S. versus another. So if I purchase a fully constructed product that was manufactured in China, and I have a single employee in the United States that just distributes that out, I have 100% of my workforce in the United States. But if I purchase 50% of that product's value add, manufactured in China, 50% of the value add is here in the United States, I got 10,000 employees in both, only 50% of my workforce is in the United States. So it looks like I'm outsourcing jobs, when in fact, I'm creating more value for that product in the United States in the second example compared to the first. I wondered if you might elucidate what some of the challenges are around this simple ratio and trying to glean real and meaningful information, which Ms. Gilbert rightfully talks about, from such a simple metric.
I don't think you can have meaningful information. I think you've elucidated it exactly right. There's just no way to take an aggregate number, and you're not going to be able to force a Chinese manufacturer to disclose its workforce data. Yeah. So the company here that is largely an import company is going to look like it's got more domestic product than the one that's manufacturing here but has subsidiaries overseas.
Right. Exactly. I wondered if you might also talk a little bit about some of the challenges about the pay ratio and how some of those disclosures might lead to misinformation rather than information, just in the metric by which it's calculated. And I believe there was a recent article that even elucidated how variable this is year to year for individual companies and how it leads to really perverse outcomes.
Well, it's going to vary year to year because driven by investors, as I said in my oral testimony, most executives are now paid with some sort of equity compensation plan, and that's to ameliorate what economists call agency costs and align them with other shareholders. So the top line is going to go up and down. Yeah. The other line is going to be relatively flat, but it's also going to create a lot of distortion because some companies may choose to have in-house workers that are lower value workers. Others will contract out with subcontractors or foreign companies to provide goods and services. And therefore, you're going to have a mismatch. And again, the company that looks like its ratio small may be small because it's outsourcing and subcontracting more.
I absolutely agree that data is really important, but having the right data and having the right metric is what we should be looking for, not just simple metrics here. And with that, I yield back.
Thank you. Without objection and consistent with past committee practices that has allowed filming at the request of a witness, the cameraman associated with one of the witnesses is permitted to film this hearing. And this is a unanimous committee request.
Reserving the right to object, I think it is important to go on the record that the minority was not consulted prior to this discussion. Consistent with House rules, filming by a non-accredited person or entity may only occur by consent of the full committee. I would ask that moving forward, the majority consult with the minority to ensure that the House rules are followed appropriately.
I have a further parliamentarian question.
Okay.
Am I recognized?
The gentlewoman is recognized.
Thank you. I've been on this committee now for 4 terms, 8 years. I've never been aware that a witness has brought in their own filming crew for, I don't know what it's for, documentation or documentary, political purposes. Is this being covered by C-SPAN as usual? Are we aware? This hearing?
Inquiry on April 30th, the committee accommodated Darrell Carter from the Multifamily Housing Council, a witness chosen by the Republican side. I note that the cameraman is remaining stationary for the remainder of this hearing.
I think that was litigated unilaterally by the majority. Majority was not aware. I'm just wondering what the filming crew is
There was no
for.
parliamentary inquiry. Okay. The gentleman from Georgia, Mr. Scott, is recognized for 5 minutes.
Thank you very much, Chair Lady. Mr. Copeland, let me start with you. I listened intently to your remarks. You said you said that it is assumed, meaning diversity, the data, the composition, that this whole issue is assumed to be of little interest to, and you quote, profit-maximizing investors. I want you to explain that, but then you go so far as to describe this issue of diversity as fitting within, and I quote, a disclosure as a soundbite. Now, Mr. Copeland, let me give you the latest data because I think that you have generalized here, and with all due respect, of course, everybody has their opinion, but let me share with you the latest information on this. And then you tell me if what we're discussing needs to be just a soundbite. African Americans and women and other minorities are drastically underrepresented in the top tiers of our companies and our corporate leadership. For example, here are the latest facts. Women represented just 5% of Fortune 500 CEOs in 2018. If that's not bad enough, even this number in 2018 has declined from what it was in 2017. The number of African American CEOs running Fortune 500 companies last year was just 3 people. And even that number has also declined in previous years. So the callousness with which your testimony has pierced this committee when it comes to the inclusion, the participation, and your denial and diminishing the significance of the problem certainly raises a great deal of eye-opening realization as to why we're having this hearing and why I hope that my information that I have relayed to you during this committee hearing will broaden your perspective and enlighten you to some facts that you were obviously dimly aware of.
Am I supposed to be able to respond to that?
Please do, sir.
Yeah, I mean, what I was saying was not at all that there's equal or even representation in terms of CEOs based on different racial minority groups or women or anything like that. And I'm not saying that's not a matter of concern. It's also not very related to this bill, right? I mean, it's very easy to get data on whether the CEO is a woman or is a racial minority or what have you. So investors are able to trade on that. What you're talking about here is a panoply of other disclosures. And when I'm talking about what profit-maximizing shareholders think, I mean, I run a website, proxymonitor.org. I track shareholder proposals at these big companies. These sorts of disclosure rules have been introduced in shareholder proposals time and again. A majority of shareholders time and again have voted against them. Now, that doesn't mean that a quantitative fund manager like Ms. Gilbert may not be able to get certain data that could be valuable to her as an investor. But I want to caution the committee that the actual investment response there may not be what you think.
I only have 5 seconds. I want to give Ms. Gilbert and Ms. Disney to give their viewpoint on this, because this is important. This is the heart of what we're talking about here. Do you all see what I'm saying?
Mr. Scott, your time is expired, and maybe the next questioner on our side can follow up on your question. But right now, the gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes.
Thank you, Madam Chair. Thanks for convening this hearing on these bills. It's good to have this very knowledgeable panel before us. I want to start and quote from Warren Buffett, the chief executive at Berkshire Hathaway, who's clearly a recognized writer and thinker as well as practitioner in this area. And Mr. Buffett says, stock buybacks are sensible for a company when its shares sell at a meaningful discount to conservatively calculated intrinsic value. Indeed, disciplined repurchases are the surest way to use funds intelligently. It's hard to go wrong when you're buying dollar bills for 80 cents or less. Buffett goes on to remind managers, however, never forget, in repurchase decisions, price is all important. Value is destroyed when purchases are made above intrinsic value. So this discussion today about buybacks, I want to start out following up on Mr. Buffett with some facts. First of all, no company wants to either buy stock back or pay too much in dividends, because that would mean their stock will be out of place in the competitive capital markets. But if you look since 1880, companies have a process of returning about 73% of earnings since that time. 140 years, and they do that through both dividends and now, in the last 40 years or so, through net share buybacks. 2018 was about 88% percentile versus that median since 1880 of 76%. So it is up higher. But if you look in 2018, why is it up higher? Why has it spiked up in 2018? It's partially due to companies returning capital to the United States. Capital that was trapped outside the United States and freed up from the tax reform, which for 40 years was a bipartisan objective to reduce the double taxation on international American profits, not so bipartisan recently. And if you look at the numbers in 2018, just 20 stocks out of the S&P 500 accounted for 70% of the buybacks, Madam Chair. And those were what? The companies that had the most money trapped overseas. So as Mr. Buffett notes, there are benefits in our economy to bringing those dollars home to the United States, benefiting shareholders. Who are the biggest beneficiaries? Shareholders. It's not, money doesn't disappear. It goes to the AFL-CIO pension fund. They have an S&P 500 index fund that they operate. It's benefited. CalPERS, mentioned by our full committee chairman, has 50% of its exposure to global equity. They benefit. Those pensioners benefit, and allows them to use that money for the highest and best use. And finally, I'm here consistently today and previously on both sides of the aisle complaining that if one is doing a buyback, that one is not investing in research and development, not developing HR, human resources issues, not involved in capital expenditures to increase growth and jobs and productivity in the United States. 2018's numbers, 14% in the S&P 500 increases in capital expenditures, a high since 2011, and in R&D spending, 11%, a high since 2006. And at 11%, that's the median over the entire history that I could find on R&D spending as a percentage of revenue in the S&P 500. So, Mr. Copeland, given that and given your work on this topic, do you agree that a buyback is a part of capital allocation that should be under the market pressures of people like Mrs. Gilbert and important institutional investors or the AFL pension fund for scrutiny, but that it is a way to let capital recirculate in our economy? Do you agree with that?
It's a vital way, and it's just unambiguous. To suggest that the companies ought to retain all their earnings is effectively saying we want our economy organized around U.S. Steel and International Paper, not Google and Facebook. That's just crazy.
And Mr. Copeland, also on the pay ratio, what's a better way to define it? I hear so many complain that they don't like the median income test, and others don't like the complexity of it. Could you submit for the writing in the record, and also Dr. Disney, if you would as well, submit for the record, how does that ratio, if it's so important to so many stakeholders, how should it be redefined? Because I think most people are very frustrated by it, maybe on both sides of the argument. Thank you, Madam Chair. I yield back.
The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
The gentleman who just spoke talked about the importance of R&D spending. I think it's critical for our economy. I would point out that the Ways and Means Committee has put into our tax law at substantial cost to American taxpayers incentives to encourage R&D, but this committee has, without paying any attention to it, allowed the SEC to allow the FASB to put in dramatically illogical, accounting theory wrong accounting standards that discourage expenditures on R&D. And if we care about R&D and we care about the responsibilities of this committee, we ought to be acting to repeal FASB pronouncement number 2, which discourages R&D and at a time when Congress has decided it's worth taking money away from people and from important programs and only to encourage it. We're talking here about CEO pay, and when we talk about CEO pay and we use that to drive up wages a bit, that's a good thing. But we need an economic policy that creates a labor shortage so that we'll see the real wage increases that we need. And we need to educate and provide apprenticeship programs for our workers so that they are more valuable and are paid more. But when we talk about CEO pay in the context of a fair society, let us remember that the heirs and the entrepreneurs have far more money than the CEOs. And that if we want to deal with fairness, it's not a matter of just taking some big-name CEO and having them paid less. We need a much more progressive income tax. We need an estate tax that matters, the way we did under Ronald Reagan. We need perhaps a wealth tax, as has been proposed by at least some senators, and we may consider taxes on unrealized capital gain. But for us to say that all of the problems with wealth distribution are because of 5 or 10 CEOs or 20 or 30 CEOs is absurd. I'll point out that Bezos probably makes more money than Iger by a long shot, but has no salary at all. Pays himself nothing. It's all in unrealized appreciation, minus divorce expenses. Mr. Clifford, when a corporation has makes money, it can either invest it if it has good places to invest it. It can use it as reserves, or it can distribute it. So we are going to see some corporate distributions. In fact, if there were no corporate distributions, nobody would own stock, and every share would be worthless. So the issue is share buybacks versus dividends. Back in the old day, companies paid dividends. Most CEOs have stock options. Does a CEO benefit more if the money is paid out as a stock buyback, which raises the value of the remaining shares, as opposed to a dividend?
The CEO, assuming they make that calculation, they will calculate what will maximize stock price. So
Do most stock options have an adjustment for dividends paid while the option's outstanding?
Most do.
Most do. So the CEO would benefit if you retain the money, the stock's worth more.
He might.
He might.
He is certain to benefit when.
And I'll point out on
have the
diversity,
buyback.
I just slipped into referring to the CEO as a he, and maybe I've spent. I know, and that's 95% true. It certainly shouldn't be. Go ahead.
The CEO has a compelling, quick way to cash out when he has a buyback. An increase of a dividend provides, and I'll use the male pronoun now, provides him a small amount of money. So those things are not the same as far as somebody who is planning to cash out soon.
Is there another reason corporations have preferred the buyback rather than the dividends of old? Is it a tax advantage still? There used to be a tax advantage.
I think what happened, there are two drivers. One is that it benefits the executives who are cashing out. It also keeps the activist shareholders off their back. So those are two great incentives to have a buyback rather than a dividend and a reinvestment.
Well, let's hear it for
Woman's time has
activist
expired.
shareholders and yield back.
Madam Chairman, I believe I have a parliamentarian inquiry at the table here. I don't believe the UC has been properly propounded. So I've got a couple of questions. I see that Dr. Disney.
Well, first of all, I'd like to ask, does the gentleman withdraw his reservation?
I do. Our concerns have been noted on the record.
Okay.
I reserve the right to object.
You object that he's withdrawing his reservation?
I'm reserving the right to object, and I have a couple of
I don't
questions
believe
to
you
the
can.
chair.
I don't believe you can reserve at this point.
He withdrew his, so
And our understanding is that the filming is for a personal biography for Dr. Disney.
Well, and that is my question. Just a
And I
simple
now
question to the chair.
recognize
No,
the
Madam
gentleman
Chair, I have
from
a
Ohio.
parliamentarian inquiry.
Okay.
I'd like to know the purpose of the filming. It's highly unusual that Dr. Disney or that any witness would not use the C-SPAN coverage and would bring in their own professional filming crew in here. I'm wondering if this is going to be shown to the public. I'm also wondering from the chair if this is for profit or a not-for-profit entity. And I would just like those questions answered, if possible, please. Of my friend, the chair.
If the gentlelady would yield.
Right now, I'd like to clarify, the hearing is not being filmed by C-SPAN. Subcommittee hearing frequently are, but this one is not being filmed by C-SPAN.
And what is the purpose of Dr. Disney's professional film crew being here? Is this being personally used? Is this being shown to the public? Is it a for-profit or a not-for-profit entity?
It's for a personal biography, is my understanding. Correct me if I'm wrong, Dr. Disney, personal?
I'm happy to answer. I'm hoping
yeah.
perhaps to make a film about the issue of income inequality, and this might figure into it in some way, so we brought it.
So this is documentary film
film, yeah.
that will be shown to the public.
Yes.
Is this a for-profit or not-for-profit entity?
It might be a for-profit entity, but I've certainly never seen a profit on any of it. But it's likely maybe to be seen at film festivals. We may never use any of the footage we're shooting here.
Will the gentlelady yield?
Yes.
I've seen news cameras in hearings for the last 22 years. I'm told that Fox News is a profit-making entity.
Reclaiming my time, I don't believe this is a, I don't believe that
This is not a proper parliamentary inquiry at this point. The gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes.
I object to the UC, and I have a parliamentarian inquiry at the table. And I would like to, I do not believe that a film crew is an accredited news organization. This is not the press. And you're telling me that this may be used for you as a for-profit entity and shown to the public?
Perhaps, and believe me, it will be part of a larger not-for-profit scheme.
Mm-hmm. Well, again, going back, and I will yield back my time, but as the ranking member, currently Congressman Hollingsworth, has said, it would certainly be appropriate in the future if the full committee is aware of this, these goings-on, and can
Your
certainly...
objections have been noted, and in the interest of time, I think we should move forward. The gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes.
Will you see this?
Thank you, Madam Chair. I thank our witnesses. And as a point of clarification, am I to understand, Madam Chair, that the only public record of this isn't really public? It's privately owned by Ms. Disney or whomever she's contracted? There is no record provided by C-SPAN on this?
That's my understanding, that this hearing is not being filmed by C-SPAN for some reason.
Move to adjourn.
The committee has it.
Okay, move to table?
Move to table.
Okay. All those in favor of tabling? Say aye.
Aye.
All those opposed, say no? In the opinion
Table
of
an adjournment. That's not proper.
the ayes have it.
privilege
In the
motion.
opinion of the chair, the ayes have it.
You cannot table an adjournment, Madam Chair. You have to vote on it.
Well, all those in favor of the move to adjourn, say aye. Aye. All those opposed, say nay.
Nay.
Nay. In the opinion of the chair, the nays have it. Mr. Davidson is now recognized.
Thank you, Madam Chair. As a further point of clarification, is there a record that can be made public that is provided by the committee and not C-SPAN?
It's online. It's online.
Thank you, Madam Chair.
All right, Mr. Davidson, are you going to continue with your
Yes,
testimony?
so as my time rapidly burns away for non-productive activities, we'd like to talk a little bit about productive activities, which is how do we make America continue to be the world's land of opportunity? We see that every day because people from around the world want to come to the United States. Personally come, they want to move their companies here, they want to move their capital here, they want to put their intellectual property here. What's increasingly true is they do not want to go public here. Particularly small companies don't want to go public here. And while I can't endorse all of the recommendations of this paper, I believe the research on the topic is important, and I'd ask unanimous consent that this paper for the Harvard Kennedy School by Marshall Lux and Jack Peed be submitted.
Without objection.
I think the debate here is really, in some way, about who owns the capital. So if someone owns the capital of a company, they're a single shareholder, and they decide, let's go public and share in this upside of the company will get the capital to scale it. That's historically been the reason that they go public. But as we have the debate here, as my colleague, Mr. Hollingsworth, pointed out, we're looking at socializing that. And not even socializing it for the people that actually own the shares or own the capital, but because we vote here in Congress that somehow you don't actually own the capital, that you don't actually have the discretion as to what to do with your company, that the board couldn't possibly be trusted to set the compensation package for the officers and directors of the corporation, and you couldn't possibly trust the officers and directors of the corporation to compensate their employees, that you couldn't possibly trust private owners of capital with the decision of whether or not to buy shares and at what price to buy them. So as my colleague pointed out, if you don't want to call this socialism, I suppose you can call it something else: central planning, Marxism, neo-Marxism, something that takes away the private ownership of capital. So I look forward to the words that define it, but it certainly isn't the path that made our country the world's land of opportunity. Our country has outperformed the world in every rational metric with respect to capital formation. We have the best markets for goods, services, capital, intellectual property, and historically for people. But I was intrigued as my colleague, Mr. Sherman, talked about labor and the labor market. We need to create labor shortages. We have the lowest unemployment on record for every demographic that we track it for, and we increasingly track it by an amazing number of parsed definitions of identity. And it's the lowest on record for everything that we can track, and at the same time that's true, these socialist ideas are forming and gaining traction with a certain segment of our society, including people that are benefiting greatly. And so, Ms. Slavkin-Corzo, you touched for a little bit in your testimony regarding private equity. And since you've raised the topic, I heard recently that there's a private equity funded project at the JFK airport that's putting 4,000 union members to work and will create 8,000 permanent union jobs upon completion. Can you tell us how many AFL-CIO workers are currently employed by private equity-backed funds?
You know, when we talk about private equity, the reason that we're concerned is because of the impact on the economy, on workers, on pension plans, and on the excessive risk that we're seeing in the corporate debt markets as a result. So while it's true that there are some union members that are employed by private equity-owned companies, the reality is that the strategy we see time and again, but when private equity firms...
So reclaiming my time, is the purpose here to grow America's economy or to grow the union workforce? And the reality is not just union workforces, the entire American workforce is benefiting from this era of prosperity.
This gentleman's time has expired. Without objection and consistent with past committee practices that has allowed filming at the request of a witness, the cameraman associated with one of the witnesses is permitted to film this hearing. The gentleman from Illinois, Mr. Foster, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you to our witnesses. Ms. Disney, the paths of your family's company and mine crossed about 40 years ago when I guess I was about 25 years old. I designed and programmed the control system for the Disneyland Main Street Electrical Parade. And, you know, that was one of the first big contracts for our company, which is something that my brother and I started in our basement with $500 from my parents. And, you know, our company is, you know, big and successful. It employs over 1,000 people today and manufactures in the Midwest, which is something I'm very proud of. But our companies have actually, the companies of our families have gone down different roads in recent years. You know, you described the path that you're not completely happy with, that your family's company has gone down. In our case, we chose an employee stock ownership plan, an ESOP, where you get an equity stake by the workers in their company. And I was wondering, you know, I see a lot of merit in this. I see it not only in sort of a social justice point of view, but also in just the enthusiasm that the employees have in the continued survival and thriving of your company. So I was wondering if any of the witnesses, Mr. Clifford or anyone else, has a comment on the ESOP model as a way to try to better align the incentives of the corporation and the workers.
Disney had an employee stock ownership program, which has gradually dissipated and has ultimately disappeared, especially for workers at the lowest level. It's been pushed more generously and more uphill than it's ever been. And the important thing to note here is we're having kind of this parallel conversation about what's good for investors and what's good for people who work. And it's important to note that 80% of stocks are held by 10% of Americans. So yes, it's wonderful that capital markets move unrestrained, and no one is suggesting socialism, and no one is suggesting a one-size-fits-all, and it's an absurd suggestion to say that we are. But what we are saying is that, yes, boards cannot be trusted to compensate well and fairly for the reason that most of the people monitoring that compensation are CEOs or want to be CEOs, and they will not peel off from orthodoxy about compensation. They can't be trusted to increase diversity. There are more CEOs named John in the Fortune 500 than there are women CEOs overall.
Thank you.
So we
Does
know
anyone,
that we can.
any of our other witnesses have comments on ESOPs?
There's certainly benefits of ESOPs in terms of alignment of interest between the workers and the other share owners. There are also complications that can arise. I think from a worker perspective, when a worker is choosing how they are compensated, clearly cash is the best form of compensation. In addition to this, there are examples that will often make workers somewhat concerned about employee stock ownership. Ms. Axney mentioned her tenure with the Tribune Company. This is an example where an ESOP was not successful, and the workers felt like they ended up on the losing end of the deal. And so there are a lot of tricky complications that can come into play, but clearly when we have so much money that's being allocated to shareholders, giving workers a stake in that would be helpful.
When they work, they're a thing of beauty, but they're very hard to pull off, as you undoubtedly know.
Yeah, no, you have to be very careful that the workers understand the risks of future performance of the company. And then,
Yeah, just to clarify, we've seen ESOPs in certain industries, particularly those with hostile union relations. There are significant risks to an ESOP in the sense that the worker's already at risk of losing his or her job, but if you wrap their pension up with the company too, you could put their retirement security in the same place. And we saw that with the collapse of Enron, where a lot of workers were invested in the company. So there are problems with it, and just generally there's a reason why we have share ownership versus employee ownership. I'd commend to the committee Professor Henry Hansman's book, The Ownership of Enterprises, which goes through employee-owned and other sorts of ownership structures and explains sort of why that is. It's too complicated to get in here.
Yeah, Ms. Gilbert, I was interested in your comments having alluded to the looming problem of robots taking everyone's jobs, basically. And so is there a concern here that by effectively adding expenses to a human worker, that someone that a CEO faced with a choice of either making an investment in human resources or just buying new hardware, that you will be pushing things in the direction of hardware that displaces jobs rather than creates them?
Yes, thank you for your question. This is the concern that I was hoping to raise in my testimony. Currently, we don't have the data available to be able to study this issue at the individual company level, but as all of you know, this is really a national issue. If we think about our national economy as an aggregate of all of the individual companies in it, then if we were able to get better data about worker turnover—
The gentleman's time has expired. The gentleman from Wisconsin, Mr. Duffy, is recognized for 5 minutes.
Thank you, Madam Chair. Welcome, panel. There was, I think, 26 institutional investors or groups that supported one of these bills that is being advanced by the majority on disclosure of human capital management. CalPERS, CalSTRS, UAW, I believe AFL-CIO was part of that as well. Does the panel know whether CalPERS, UAW, AFL-CIO make the disclosures that they're requesting of private corporations?
So I can tell you from the AFL-CIO's perspective that we make extensive personal information about each employee and their salary
But how about this, too?
available in accordance with the Department of Labor's
But
requirements.
on the, you recommended a set of standards for public companies. Do you abide by the standards that you think the public company should abide by? Do you abide by those at the AFL-CIO?
We disclose a tremendous
That's not my question.
amount of
That's
information.
not my question.
Also, we
So
are
I'll
not a
take-
public company. We
I
are
know.
not asking for investment.
take your
We're
answer
not
as-
asking for capital from
I will,
outside
I will
parties.
take your answer as, no, you do not. You do not. UAW does not. We do not know the pay disparity. We don't know the gender breakdown. We don't know the minority breakdown. And I find it fascinating, what's good for the goose is not good for the gander.
At UAW,
I'm going to
we
reclaim my
actually
time.
do know
I'm
the pay
going to
disparity.
reclaim my time. I think this is a better place in the work that Ms. Corso, you're involved in, for shareholder initiatives. Let the owners of the companies decide. You can bring forward an initiative, have a vote, but to have this dictated from Congress, I have a fundamental disagreement, and there's a lot of priorities that come before public companies. Let them have a vote. This is a democracy. But to mandate this by the Congress, I have a fundamental disagreement. And I would just note in regard to pay, and this might be different in different parts of the country, in my community, over the last 2 years, there are so many jobs. We have more jobs available than people to fill the jobs. And so if you are a minority, if you're a woman, or if you're anybody else, and you're not being treated fairly, you're not getting compensated fairly, guess what? They pack up and they go down the street and they do get compensated fairly because another company will snatch them up and hire them and pay them their worth. It's happening all over my community to the frustration of employers that there's poaching of the workforce. One second, I'm going to get to this other point. I apologize, and you can answer when I come over to you. But you're all here, most of you are here, in regard to public disclosure. We want public disclosure. So, Ms. Maloney, I can tell you that she makes $174,000 a year, and so does everybody else here. Pretty tough for any of these other people to make any more money. So to the panel, Mr. Clifford, let's start with you. How much do you make, not just on your salary, but on your investments? I can't wait to get to Mrs. Disney.
I don't have a salary. I don't work. I'm retired.
Your investments, then?
On my investments.
You can take out Social Security.
On my investments and my board fees, about $450,000 a year.
Ms. Corzo?
I'm not going to disclose my personal
You're not going to disclose. Surprising. Ms. Disney?
Something in the range of $5 to $6 million. I also give away about $7 to $8 million a year.
And what's it? Say that one more time.
Something in the range of $5 to $6 million annually. I also give away $7 to $8 million annually.
And because you're worth about $500 million, is that fair?
No, I'm not worth $500 million.
Then the news reports might be wrong. Ms. Gilbert?
So wrong.
Ms. Gilbert?
The owners of my firm are fully aware of my compensation, and
Well, let's
that's
share-
what we're asking of publicly traded companies.
So we don't want to
as
share
well.
that here. Okay. Mr. Kaplan? Interesting.
I'm not going to tell you.
I want to go to Ms. Disney. So obviously you have incredible wealth. I would imagine that you probably
Dr.
have...
Disney, thank you.
What's that?
Dr. Disney.
Dr. Disney, yes. Do you have people that work for you in your home?
Yes.
Someone that maybe cleans your home, maybe cares for your pets? How much do you pay them?
Angie, how much do I pay Concha?
At the lowest level, the lowest employee.
Something in the range of $75,000 a year, something like that.
Okay, so you're making $6 million and you're paying $75,000, and that's the lowest salary that you give someone in your home?
I think so, yeah.
Okay.
Yeah. Do you think that's an unfair wage to pay a domestic worker?
I don't know. You tell me. If in San Francisco, it may be. You live on $75,000?
I would tell you that it's the highest I've ever
For the
heard
record,
of
I would
anyone
note
paying
that
a
it's
domestic worker.
fascinating that we want disclosures, but in our unions, we're unwilling to disclose
Excuse me, the
amount
gentleman's
that we
time has
make.
expired.
I
The
find it
gentleman's time
troubling.
has expired.
And I'll yield back.
The gentlewoman from Iowa, Ms. Axney, is recognized for 5 minutes.
Thank you, Madam Chair. I've heard a lot of discussion today about the burden that these disclosures could put on companies. And let's be very clear. Companies are already looking at this information, and the ones who are operating the best are using this to their full advantage, and that is for their investors, their stockholders, and their employees. I've spent 18 years of my career working on many of these same issues in public companies as well as state government. And companies are already tracking these metrics, the majority of the metrics that we're actually asking for. This bill is all about balancing a company's incentives to maximize short-term profits with the need to reinvest in their workforce and their company for the long term. I know it works. Our top business schools know it works, which is why they offer and promote majors in human capital management and organizational development. I hope all of my colleagues believe that business schools like my alma mater, Northwestern's Kellogg School of Management, aren't selling our businesses a bill of goods, because I don't think they are. They're promoting these studies because they benefit businesses. And research shows that how you manage your people has long-term effects on profitability. So, Mr. Copeland, you said in your testimony that there is little reason to believe that such disclosures are material to a profit-maximizing investor. I think the SEC Chairman Clayton might disagree, as he's indicated several times he'd like to see more disclosure on human capital management. And then I also have research from Lancaster University showing that U.S. companies that disclose their investment in human capital have outperformed those who don't. And so I'd like to ask you, Ms. Gilbert, as a portfolio manager, can you explain how these disclosures will help you maximize returns on your fund?
Well, I'd like to point to some of the specific items that have been requested. Coming back to the disclosure, for example, around workforce diversity that's been discussed during the hearing already. As a portfolio manager, we think about how this information can help to drive business success. And we believe when it comes to workforce diversity that having different voices around the table helps to drive strategy in a significant way. I've completed studies that focus on this issue, for example, with regard to board diversity, because that data is available, as Mr. Copeland mentioned, but there's no reason to think that that wouldn't drive success at the level of the team. Another data item, for example, that's been discussed is compensation. When I've studied compensation issues for corporations, I actually think about it as an investor, as an issue of leadership signaling. There are essentially agency issues that can arise between a company's CEO and board and the shareholders of the firm, where we want to be sure that they're maximizing the benefits of all stakeholders, including the shareholders, relative to themselves. One way that we can measure this is how they're compensating themselves relative to others in the company. So those are just a couple of examples of how we believe that we can use human capital management data to be better and more successful investors.
Thank you, Ms. Gilbert. Moving on, I want to make sure I thank Senator Peters for the work he's done on the Outsourcing Accountability Act. I appreciate all the feedback that my colleagues have given today on this legislation, and I look forward to working with everyone on both sides of the aisle on these bills. Ms. Corzo, would you say that the public has accurate information about where public companies are creating jobs?
No.
Okay, and would you say this bill would provide information and make it more likely that we would invest in American jobs?
I think so. I think that, information is critically important here. I think that for two reasons, actually. The first is that what gets measured gets paid attention to within a company. And so the process of reporting itself will force the folks at the senior-most levels within the firm to look at the data. And then they'll also have to think about what is going to happen on their quarterly earnings calls with analysts and what the questions will be that they will be asked. And so I think that the process of disclosing that information, of preparing the disclosures and thinking about how it's going to be communicated will help to impact the behavior. I don't think it's the single silver bullet that will solve the problem, but I do think it will be helpful.
Thank you. And I've got 20 seconds left about. I would just like to impress on my colleagues the importance of moving forward these bills. In particular, as we continue to build a knowledge-based economy, it's incredibly important to value that asset, and we're overlooking that in many ways, and this will help with it. Thank you.
The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Madam Chair. Mr. Copeland, a couple of quick questions. What percent of U.S. equities are held by foreigners?
I'm not certain. I could get back to the committee on it.
Does anybody else on the panel know the answer to that question? In terms of the total capital in U.S. companies' equity and debt, it's about 30%. Given that, when we give $1 of money from the U.S. Treasury to corporations in the form of a tax cut, Mr. Copeland, and they use that for stock buybacks or paying down dividends, what percentage leaves the country?
Well, I would question the premise that a tax cut is a gift away of $1, but clearly if 30% of the owners are foreign, then 30% of the beneficiaries would be foreign.
Okay, I wanted to make that point because your comment that that share buybacks are good for U.S. companies presumes that only Americans own U.S. companies, and it simply isn't true, and those trends are increasing. Mr. Clifford, in your piece in The Atlantic, you had mentioned that that a CEO provides guidance and oversight, but it's the typical employee who is actually the one producing a good or service. Can you talk a little bit about why it is that over 2 decades of productivity growth, the gains from productivity growth have overwhelmingly gone to the executive suite while median wages have stayed basically stagnant?
Yeah, it's very simple. The boards have adopted a certain way of paying CEOs. As I said, it's a very complicated system, but it starts with you assemble a peer group. They're always very highly paid other CEOs. Then your board pegs you at the 75th percentile of that peer group. I've never seen anybody pegged below the 50th percentile. Then you have a series of bonus targets, and if you surpass those bonus targets, you make more than the 75th percentile. So you end up, you're in a pretty good negotiating position. You have all the you have all the information as CEO. So you end up making probably 2.5 times your target. Now here's the beauty of that. That then goes back into the peer group of all your other peers. They get a raise next year just because you get a raise. You get a raise the year after because they got a raise. So you have this system that, with mathematical certainty, produces 10% increases in CEO pay. Now, this works only at the CEO level. They would never apply this cockamamie system to anybody else. Everybody else gets 4%, and because they're all using this system, the CEO gets 10%, 12% year after year. And you just turn the cranks, and the 12% shoots right out. That's why you have it.
Thank you. Moving to Ms. Gilbert. There's been this long shift towards shareholder capitalism and aligning compensation with equity performance, and that's not without its merits. It certainly keeps people aligned. But most of my career was as a CEO, so I'm familiar with how these things can be gamed, particularly when you have options that are with strike prices below the listing price of the stock. The CEO, as you all know, has essentially a one-way bet, and they don't share any of the downside exposure that the investors have, but have tons of upside potential. Can you help us quantify how prevalent that trend is? And in your capacity, in your role, how might we either fix that from a board governance perspective, or in the absence of leadership from a board governance, from a regulatory perspective, that this committee would have jurisdiction over?
I'm sorry to say that I haven't had the chance to study this in detail, so can't quantify for you the prevalence. But with regard to strategies for changing the patterns around shareholder primacy, one important focus would be to begin to find ways to train capital markets, shareholders, and leaders to focus on longer-term goals, longer-term performance. And this can be built directly into the compensation plans themselves. Part of the problem that you're describing, you talk about the option, it's not just the strike price that's part of the option, it's also the time horizon, as you know. So I believe that if we are able to train our goals on longer-term issues, longer-term focus, that it would change all of the other behaviors underneath.
Thank you. I yield back my time.
The gentlewoman from New York, Ms. Ocasio-Cortez. is recognized for 5 minutes.
Thank you, Chairwoman, and thank you for holding this extremely important hearing. Thank you all to all of our witnesses here today. It's so important that we talk about some of these issues. So, you know, folks consistently bring up this term stock buyback, stock buyback, but a lot of folks don't really understand what this really means. So let's break it down. Ms. Slavkin-Corso, let's say I'm the CEO of a major corporation. Let's say I'm the CEO of a big pharmaceutical company or a big retailer like Toys R Us or Sears, and a company that's big enough and developed to the point where it can be traded on the stock market. So you can buy and sell shares of Toys R Us or Merck or what have you. So my first question is it common for CEOs to have their pay tied to stock price?
Absolutely, and as Mr. Clifford was just explaining.
Microphone, please.
I'm sorry, thank you. Absolutely, and as Mr. Clifford was just explaining, that's typical, and when you buy, this is typical supply and demand, right? When you buy stock, the supply goes down, the price goes up, and then a lot of the metrics that go into the calculation help increase the pay.
So it's exceedingly common for CEOs of these major corporations to have their pay tied to the stock price. So great, so I'm the CEO, my compensation package is based on the performance of the stock price. And I think it's fair to say that that means I'm incentivized to make that stock price as high as possible, right? If I want a huge payday, I need to make sure that this stock price on the Dow Jones or on the NASDAQ is as sky high as possible. And to clarify, stock price doesn't always immediately or directly correlate to the actual value of the product that I'm selling, correct? So it's not as though, it's not as though my product is getting more valuable if the stock price increases, right?
Right.
Okay, good to know. And it generally can create a situation where it prioritizes the interests of the shareholders more than the actual consumers of the product or even the employees of the company?
Absolutely.
All right, so let's say I'm, again, the CEO, I'm ruthlessly incentivized to make sure that we get this stock price as high as possible. And usually that means just increasing profit for shareholders. So I need to find a way to build this margin. So let's say I take away health care from my workers, right? I can make a huge killing making sure that we don't pay for anybody's health care. Let's take their insurance away. Or let's just say, hypothetically, I get a slew of hired gun lobbyists to buy up members of Congress to secure the largest tax cut in the history of the United States. So I get a big chunk from that. So now, okay, I've got that money. Am I allowed, a lot of folks, my dad, in real life, let me take my CEO hat off, but in real life, my dad ran a small business. And whenever we had a good year in the small business, we tried to pay our secretaries more, or we tried to invest more in things for the business. But as a CEO of a major company, I can take that money, and I don't have to do that at all, right? I can actually have the company buy its own stock on the market, right?
Yeah.
So let's say if I'm a big pharma CEO, I can go take this money, take people's health care away, take that margin, and buy my own stock on the NASDAQ. And that would effectively increase the stock price, right?
Yeah.
And I've done nothing to change my company, right? I've done nothing to make my product more valuable, my employees more happy. I haven't invested in the training or the workforce to make the company inherently more valuable, but I've inflated the stock price, right?
Absolutely right.
So my question is, how is this different from a pyramid scheme?
No, that's a very good question. It's a concern that I think a lot of people talk about when we talk about financialization, right? This is the concept that we're seeing so much in our economy when there's a lot of effort going into driving up stock prices, driving up the value of financial assets that does nothing for the real economy.
And I think that has an additional expense, because when you look at, for example, the GOP tax scam, about 60% of all of those proceeds went to stock buybacks. And now today we're being told that GDP is at an all-time high, but GDP tends to be indicators of company and corporate value. Is that correct? Yeah. So it's possible that our GDP numbers are going up without any actual value added to our economy. Is that correct?
That's correct.
All right, well, that's concerning. Well, Dr. Disney, just one last question. you again, my mistake. Your grandfather was the co-founder of the Walt Disney Company, correct?
Yes.
And as you indicated earlier, the CEO was paid $65.6 million, even though the median salary is $46,000. Do you agree with that?
Yes.
The
And do you think that's
gentleman's
right?
time has expired.
Thank you. Thank you, Chairwoman.
The gentleman from Illinois, Mr. Garcia, is recognized for 5 minutes.
Thank you, Madam Chair. And I'd like to thank all the witnesses who have testified this morning. Some questions for the panel. Ms. Slapkin-Corzo, you mentioned in your testimony the problems that buybacks at Walmart and General Electric have caused for workers at those companies. Of course, it isn't just those companies that have spent their funds or buybacks rather than in jobs and growth. Earlier this year, Joe Olson, an AT&T employee, testified before the Senate that the company has spent $16.5 billion on buybacks since 2013 and spent more on buybacks last year than it has in several years, even as AT&T has cut 23,000 jobs. Since the passage of the Corporate Tax Act, AT&T has laid off 2,300 call center workers in the upper Midwest, where I'm from, alone. So it seems like these problems are widespread across corporate America. In that context, should this committee consider eliminating the safe harbor that currently exists for stock buybacks as proposed in Senator Baldwin's Reward Work Act?
Yes, the AFL-CIO and Americans for Financial Reform have both endorsed that bill. And I would add that one of the things that is particularly attractive is that it puts workers on boards in addition to addressing the stock buyback.
Upon introducing the Reward Work Act earlier this year, Senator Baldwin, her staff issued a report that found, quote, buybacks suppress wages, drive income and wealth inequality, decrease investment, increase systemic risk, harm retirement savers, and jeopardize capital formation by allowing speculators to extract value from public companies. I'd ask to enter this staff report into the congressional record, thus seeking
Without objection.
unanimous consent. Thank you. One powerful example of this extraction cited in the report is the case of activist investor Carl Icahn, who purchased 3.4 billion shares in 2013 and 2014, and from other shareholders, then successfully demanded that Apple accelerate its stock buybacks again, selling his newly more valuable shares at a $2 billion profit. As the report notes, quote, Apple calls its buyback program the capital return program, yet the company isn't returning cash to shareholders like Icahn because they haven't given the company anything. Icahn sold his Apple shares after holding them for 32 months for a $2 billion gain. This example illustrates how activist investors use stock markets to take cash out of company rather than supply companies cash to put to productive use, rewarding the wealth of the activist, not the work of the employee who generated the profits in the first place. Ms. Slapkin-Corzo, can you comment on how common examples of extractive behavior like Icahn's are?
Unfortunately, I'm not able to quantify.
Mike, please.
Unfortunately, I'm not able to quantify that, but it's very commonplace. It's a common strategy that we see among private funds quite a bit. We hear a lot from private fund managers that the reason that they make so much money is because they have some sort of special miracle way of getting into a business and finding the way to drive value creation, when in reality, a lot of what we're seeing is wealth extraction. And there's an important difference, because value creation is what makes our economy profitable in the long term, what drives real economic growth that helps all members of our society to live better lives, whereas value extraction only benefits those at the very top. And that's a lot of the time the strategy that we're seeing from these activist investors, which are typically hedge funds.
And in my 30 seconds that are left, I want to ask you, is it, in your opinion, in the interest of long-term interest of pension funds and other investors that are supposed to look out for the long-term interest of workers and other investors that they represent to engage in this?
Absolutely not. A pension fund is looking out for returns not just today, but 40, 50 years from now. We need to provide for the retirement security of our members corporate strategies that will drive profitability over decades to come, not just the next quarter.
Gentleman's time has expired.
Thank you, Madam Chair.
The gentleman from Minnesota, Mr. Phillips, is recognized for 5 minutes.
Thank you, Madam Chair, and thanks for the invitation to join the subcommittee hearing today and to our witnesses. In the spirit of full disclosure, I am a capitalist, an entrepreneur, a recovering CEO myself, someone who has co-owned 2 consumer brands that I think most Americans are quite familiar with, and also someone who believes that business can and should be a means to an end. The end should not be the aggregation, rather the sharing with the people and the communities that make success possible. So that's why I believe that wealth and income disparities are a great threat to our country. And recognizing the data, our real average wage in this country is about the same as it was 40 years ago. In 1965, the average CEO to employee ratio was compensation ratio was 20 to 1. Now it is 312 to 1, which would mean that my fellow members of Congress and I would each be making $18 million right now if we applied the same ratio. And I'd love to know what American citizens would think of that number. I hazard a guess. So my first question, though, to each of you is a simple one, and just a yes or no answer. Do you believe that growing wealth and income disparities pose an economic and social risk to our country? Mr. Clifford.
Yes.
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 No and yes, depending on which question you're talking about.
Mr.
Economic,
Copeland,
no. Social, yes.
Economic, no, and social, yes.
No, social, yes.
So Mr. Copeland, you might know, in your opening remarks, you mentioned that the propositions that we're considering may well retard economic growth in the United States of America. My bill is a very simple one, Greater Accountability and Pay Act. It is all about transparency. So let me know, how does transparency pose an economic threat to the United States of America?
Because you're asking the wrong question with the wrong metric,
Okay.
and therefore you're going to have, exactly as I discussed earlier in the hearing, you're going to have situations where a company that contracts out is going to have very different ratios than a company that has workers in-house. So the actual ratio you're talking about, and we've seen the same thing with the aggregate static pay ratio bill that was added into Dodd-Frank, the rule that was promulgated after that. But what you're talking about is going to exacerbate that, because you're actually talking about raises. You're talking about year-over-year changes, and those are going to fluctuate widely at the top due to the equity compensation that institutional investors have driven on corporate boards.
Then let me ask you a follow-up question. What do you believe, or what thoughtful policies should we be considering to provide incentives to American corporations, public and private, to share more with their employees, the people that make success possible?
I don't think that's a useful strategy for economic growth, is the answer. Because
let me just clarify. So sharing more is not a recipe for economic growth.
Paying workers more than the marginal utility of their labor is not a strategy for a business to grow. And ultimately, what you'll be doing is, if you're overpaying your workers more than their marginal productivity of labor, you're going to be losing business to foreign competitors or to other competitors not subject to that rule.
And that's not my problem. My question is incentives for businesses, public and private, to share more. What policies should we consider?
Share is a very nebulous term there.
Okay.
But if what you're talking about is driving up employee compensation relative to the marginal productivity of labor, relative to what it's paid in a competitive labor market, then you're driving down the competitiveness of the company, which is in the long run going to retard the economic growth of the country.
So your argument is that the status quo is in the best interest of the future of the country?
I'm not saying the status quo. I've criticized the status quo a lot of times, but I think what you're proposing is to go in the exact wrong direction.
Okay, simply exposing the increase in pay amongst executives at a public corporation with those of their own employees, that's...
Well,
That's not just...
Discussing it is fine.
Okay.
It's just not a useful metric that's material to investment.
Okay. Any other members, or any other, I should say, of those witnesses here today, any thoughts on what we should be considering to provide incentives to share more with employees?
Well, I would just love to just spend a minute with the idea of the marginal utility of labor. We've been talking in parallel lines this whole thing. We've been talking about what investors need, and then in a completely separate way talking about what workers need. And these should not be separate and independent issues. We need to restructure what we measure and what we understand about the purpose of business and the purpose of an economy so that labor's interests are not inherently in conflict with what investors needs. So the marginal utility of a toilet being scrubbed, I would argue, is actually high. You can't run your business without that. And to make a person work 8 to 10 to 12 hours a day scrubbing toilets and ask them to go home with not enough money to feed their families is just, on its face, a ridiculous way for an
I
economy
agree, and
to be
thank you, Dr.
structured.
Disney. I yield back.
The gentleman's time has expired. Before we wrap up, I'd like to take care of one administrative matter. Without objection, I'd like to submit letters and statements to the record from the Council of Institutional Investors, from Public Citizen, Dr. Anthony Heskett, a group of academics including Laurie Foster, Dan Arley, and David Van Adelsberg, and an article by Mr. Hill from Arizona, and I'd like to, from Arkansas. And I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as possible, and without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. This hearing is adjourned. Thank you.
They're scared of asking you questions.